what value can we get from having one? So this is a sample set of family. We got Jack and Diane. We got a little ditty about them here. So this opening screen doesn't mean much to you right now, but let's dive in and see how can we make this plan better. You see 81% probability of success. What does that really even mean? Doesn't mean anything. And you can see their net worth launching and then going down over time. What can we do to make that a little stronger? So let's meet Jack and Diane. They are currently mid-50s. They have a planning horizon or life expectancy of 90 for Jack, and Diane is 92. So we're going to talk about who this couple is, what they have, what they owe, what they make, what they want to, when they want to retire, current spending, future spending goals, and what can we do with this data to optimize their net worth. You can see here we could also add children, grandchildren, anything like that to make gifting and 529 planning better, but we're going to keep it real simple and high level today. So over here in the net worth tab, looks like they've got a bank account and we're just calling it cash. They've got a few different kinds of investments. Diane's got a conservative 401k, 600,000, and it's conservative, 40%, 60%. So that first number is equities or stocks, also known as risk. The second number is the safer side. So bonds, fixed income, things like that. 40-60 means you got more safe stuff than risky stuff typically. And for someone in their 50s, that may or may not make sense. I'm going to propose something different here in a moment. Jack's got an IRA, 70-30, and they've got a joint investment account of about $1 million, and that's 50-50. Again, personally, I think it's a little conservative, but we'll discuss a little more. They do have a little bit remaining on their mortgage. They're hoping to pay that off before they retire. We can see details and payoff and all that fun stuff. And then the house itself, 700,000. It's appreciated some, but I'm keeping some of this just super simple for today. Let's go look at their current income levels. So Diane's making 120. Just get a little bit of a annual increase expected. Jack, self-employment, it's about making the same thing. Also a little bit of an increase planned for here. Social Security, we're just doing a flat 3,000 estimate for him at full retirement age. Same thing for Diane, but there's ways to map that out. Another set of income they have here is something unique. They got two different kinds of inheritances here. So we have an estimate in 2030, it's going to be an IRA. So this is going to be taxable income to them, and they'll have 10 years to pull it out based on current laws. In the same year, they're expecting not only the tax-deferred inheritance, but this after-tax inheritance, something on which they'll get a step-up in basis. And we'll plan and see what are something unique things we can do around that. Expenses. So right now they're spending a flat $12,000 a month on average. Savings-wise, so she's maxing out her 401k. He's doing his max. You can also put your employer's matches in here, things like that. Is any of it going to Roth? There's a lot of different ways you can save. So all these different kinds of accounts, pensions, whatever. Goal-wise, so we're thinking Jack's going to retire at 63. Diane going to keep working until 65. In retirement, let's increase their monthly spend. They're going to have a lot more free time on their hand. Don't want to feel too strapped. We're using the just national average estimates of national healthcare costs. For long-term care, we're assuming Diane can take care of Jack in his final years, and so there's no long-term care for him. And then for her, we do have a couple years of that long-term care cost, and that's in today's dollars. Although I have general inflation programmed in here at 2%, healthcare things it's inflating at 5%, just because that can get crazy, and that's not too out of whack from what's really happening. We have a plan for a daughter's wedding next year. We're going to downsize our home. Just go ahead and put 100% down. Don't want a mortgage as they approach retirement. And then we're going to spend an extra extra $15,000 a year until Jack's 75, starting when Diane retires, and just extra for retirement during those go-go years, then maybe those slow-go years, and then the no-go years. So we've got a lot of spending goals here. Retirement plan. So what are we doing here with all this data input? And a lot of this is guesses, and there's always going to be guesses. But what we're trying to do here is figure out, are we on the right path? Do we need to change something? What levers can be pulled to increase our chance at not having to worry about running out of money or or being affected by inflation, things like that. So how can we be smart today? This next screen is going to take all this input of guesses of savings and income and spending and says, okay, we've got market volatility for the rest of your life, given some average expected rate of return and some standard deviation or volatility in the market. Run 1,000 simulations. How many times did you get to that life expectancy age and not run out of money? So go to this retirement tab and we see 81% of the time, given the current inputs, they did not run out of money. And you may think, ooh, 81%, I'm an A student, I want it to be closer to 100. Truthfully, 100 is too conservative. I would encourage people to live their life more, gift more, travel more, things like that if it's close to 100, especially if it's a much more detailed, built out plan and we're still seeing a very strong outcome. I put a lot of conservative estimates in here. For example, I have the expected rate of return a little lower than typical history would suggest. And I have zero cost of living adjustments for Social Security, things like that. So there's cushion built into the plan already. So let's talk about what this says. We've got two circles here, left side and right side. So the current plan is 81. We've got these buttons down here. We can change things, and everything we change is going to affect the left side. So we can always compare it to what's currently happening. So for example, instead of 63, let's make Jack Works to 65, and Diane, sorry, you're going to die a couple years early. Obviously, if you work longer and die earlier, it's going to strengthen the plan, right? That's very clear to see, I think. So that's not what we're going to suggest here. Let's go through instead and talk about this inheritance. So what I like to do is work with a full family, multi-generational approach to financial planning. And I don't love that Jack and Diane might be inheriting a very large amount of IRA. What if they're aging parents who are really just living on their Social Security and a little bit of pension and are in a pretty low tax bracket? What if we had them pull out some of that IRA every year, more than the required minimum distribution, but let's do advanced distributions, have them pay tax on it at their 12% bracket. And instead, what happens is IRA inheritance goes down to zero, and we make this basically reduce it by 12%. I know that's not exactly how it works, simple numbers, but just to show you so they're getting a smaller inheritance, but it's more tax efficient. So we're adding increased probability, and what did that add? $180,000 in today's dollars. So in future dollars, that's probably like $400,000, but it's going to spend like today's $180,000 here in 2025. Another thing we can do, we mentioned how they were too conservative in their investments. What if their pre-retirement allocation, we did 70% stocks, and as they got into retirement, we dropped it down to 60%, and they can coast on that for the rest of their life. So we hit refresh with these new inputs, increasing the risk a little bit. Again, we've gone up a couple percent and gone up more than $500,000 from the previous screen, which is more than $1 million in the portfolio expected at life expectancy. So this 85% is kind of the sweet spot in my opinion. What I really like to see is plotting their net worth over time. So this is their age, 54, all the way up into the 90s. What's beautiful about this is it's a flat line. And a flat line kind of means you're just living off the growth. This is the median 50th percentile of outcomes. So if it's flat, essentially you could live forever. So we're not worried about outliving your money. So I really like the fact that it's a flat line here. So 85%, millions left over, and a flat line. That's a really good looking plan to me. It does dip down here at the end, but remember that's because those long-term care expenses kicked in, and that does start dragging. And some people can be on long-term care for a long time, so definitely something to consider. Other things we can do with this plan, let's look at the stress tests. The baseline plan is now up to 85% likelihood that we plan. So you'd see that this baseline on the far left, 84.6. So if the market were to drop 20% immediately and then revert back to norms thereafter, that hurts the plan a little bit, but it's still high 70s. If taxes were changed and hurt, the really big one here I'm seeing is inflation. If inflation is 2% higher than expected, that's going to really pull the plan down. And so for this family, that's definitely something to pay attention to. If they live 5 years longer, that's not like the needle, but not as much as you'd normally think. Social Security. So earlier you claim Social Security, the lower your monthly benefit is for life. The later you claim it, the bigger. But if you delay until 70 and you die at 71, you probably wished you claimed a little earlier. So there's a break even there. It looks like for this family, the delaying happens at about the break even happens at age 81, which is when, as long as they can live past 81, it seems like they will claim more in Social Security benefits over their lifetime. We have some Medicare things we could click through just to show enrollment period, start enrollment. There's links and things like that, recommendations, all that stuff is clicked in through here. Very educational. You can play with that. This cash flows tab, I don't show anybody except for maybe my engineer clients because it is too into the weeds, but it's where I go in as the advisor to figure out, okay, this plan didn't react to that change like I thought it did. Let me make sure in the weeds what we're seeing is happening. Where is this goal? Oh yeah, their property, they were relocating. And we can see here which accounts are we drawing from each year. So they're still earning income, but they're pulling down on their accounts in these early years. So a lot of different things you can play with here. But now that we have everything adjusted to where the plan's a little stronger, back at this snapshot, we see the plan's a little stronger at 85% than when we started out. Line's a little flatter, and then we've got breakdown of tax allocation, and then I can make some notes. Hey, this is your one-page snapshot financial plan. We need to adjust risk. Let's delay Social Security, file for Medicare a few months before 65. Something simple like this would be very helpful for a family, and there are so many tabs we didn't even look at. This is just a very high-level overview. One thing we didn't get into either here is Roth conversions. We can map out what Roth conversions do. So when they retire and before they claim Social Security, there's a period of low income. That's a great opportunity to go ahead and pay IRA taxes, make those Roth conversions, get it over to a tax-free bucket, because that's the best kind of asset you want to leave for next generation. Thanks.